Preparing for a syndicated loan operations, LoanIQ, agency roles, Wells Fargo, Barclays, Citi interview? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each one, you'll see what the interviewer is testing, the core concepts you should cover, and a sample answer. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Walk me through the life cycle of a syndicated loan from closing to maturity. The interviewer wants to assess your end-to-end understanding of loan operations, including deal setup, funding, interest cycles, amendments, repayments, reconciliations, and maturity processing. While answering, focus on the operational timeline, key LoanIQ events, agency versus lender responsibilities, cash movement, notices, rate setting, and how controls prevent settlement or accrual errors. A syndicated loan starts with facility setup, borrower and lender records, commitments, pricing, fees, and settlement instructions. After closing, the borrower may request drawdowns, conversions, rollovers, repayments, or amendments. Operations calculates interest, sends notices, processes cash, updates lender shares, and reconciles positions. At maturity, final principal, interest, and fees are collected and distributed. In LoanIQ, each lifecycle event must match the credit agreement and be supported by approvals and controls. Question 2. What is the role of an administrative agent in a syndicated loan? The interviewer is testing your understanding of agency bank responsibilities, especially coordination between borrower and lenders, payment administration, communication, documentation, and operational control. Make sure to cover notice distribution, interest calculations, lender allocation, amendments, consent tracking, cash waterfall, record keeping, and the agent's neutral role rather than credit risk ownership. The administrative agent is the operational coordinator for the syndicate. It does not usually own all the credit risk. Instead, it administers the facility on behalf of lenders. The agent receives borrower notices, calculates interest and fees, collects payments, distributes funds, tracks lender commitments, and manages amendments or consents. In banks like Wells Fargo, Barclays, or Citi, agency teams are expected to be precise because one incorrect allocation can impact every lender in the syndicate. Question 3. How have you used LoanIQ, or how would you approach learning it quickly in a loan operations role? This question evaluates your practical systems knowledge, adaptability, attention to detail, and ability to connect LoanIQ screens and events to real syndicated loan processing. In your answer, talk about facility setup, borrower-lender profiles, drawdowns, rollovers, repayments, accruals, fees, work queues, exception checks, and learning through procedures and deal documents. LoanIQ is the core loan servicing platform used to record the legal and economic terms of a facility. If I were new to it, I would learn by mapping each screen to the credit agreement, facilities, loans, lenders, pricing, fees, and cash events. I would focus first on high-volume tasks like drawdowns, rollovers, rate setting, and repayments. Then study exception queues, notices, and reconciliations to understand how errors surface. Question 4. What checks would you perform before processing a borrower drawdown request? The interviewer wants to assess your ability to process funding events accurately, while validating availability, notice requirements, pricing terms, currency, settlement details, and approvals. Be sure to mention commitment availability, borrowing notice timing, minimum amounts, pro rata lender funding, interest period, base rate selection, SSI validation, approvals, and cash funding deadlines. Before processing a drawdown, I would confirm the borrowing notice is valid under the credit agreement, including timing, amount, currency, interest period, and rate option. Then I would check available commitment, lender shares, minimum draw requirements, and any conditions precedent flagged by the deal team. Operationally, I would validate settlement instructions, obtain approvals, input the event in LoanIQ, generate notices, and monitor incoming lender funds before releasing money to the borrower. Question 5. How is interest calculated on a syndicated loan? And what operational risks arise during rate setting? The interviewer is testing your understanding of interest mechanics, benchmark rates, spreads, day count conventions, rate reset timing, and controls around accrual accuracy. While answering, focus on principal, benchmark rate, margin, interest period, day count, SOFR or base rate conventions, spread adjustments, rate notices, and review of accrual outputs. Interest is generally calculated using outstanding principal multiplied by the applicable rate and day count fraction. The rate may be term SOFR plus a credit spread adjustment and margin, or an alternate base rate depending on the loan election. The operational risk is using the wrong benchmark date, margin, day count, or interest period. I would verify the credit agreement, rate source, LoanIQ accrual, and lender notices before finalizing the cycle. Question 6. What is the difference between a rollover, a conversion, and a repayment? This question evaluates whether you understand common loan servicing events and can distinguish similar-looking transactions that have different accounting, cash, and notice implications. Make sure to cover that rollovers extend an existing borrowing, conversions change rate type, repayments reduce outstanding principal, and each requires correct effective dates and notices. A rollover continues an existing loan into a new interest period, usually with the same principal, but a new rate and maturity date for that tranche. A conversion changes the rate basis, such as from base rate to SOFR, without necessarily reducing principal. A repayment actually pays down outstanding principal and triggers cash movement from borrower to agent and then lenders. In LoanIQ, these events look related, but the operational impact is different. Question 7. How would you handle a lender assignment or trade settlement in a syndicated loan? The interviewer wants to assess your understanding of secondary loan trading, assignment processing, consent requirements, lender record updates, and transfer settlement controls. In your answer, talk about assignment agreements, effective date, borrower or agent consent, transfer amounts, fees, accrued interest, lender codes, SSI updates, and post-settlement reconciliation. For an assignment, I would first confirm the executed assignment documentation, effective date, transfer amount, facility, and any required borrower or agent consent. Then I would update lender positions in LoanIQ, including commitments and outstandings, and calculate any accrued interest or assignment fee. Settlement instructions must be validated for both buyer and seller. After booking, I would reconcile lender shares, notices, and cash movements to ensure the syndicate records are correct. Question 8. What fees are commonly seen in syndicated loans, and how are they handled operationally? The interviewer is testing your knowledge of loan economics beyond principal and interest, including fee types, accrual mechanics, billing, allocation, and lender distribution. Be sure to mention upfront fees, commitment fees, ticking fees, agency fees, letter of credit fees, utilization fees, fee accruals, billing schedules, and pro rata allocation. Common syndicated loan fees include upfront fees, commitment fees on undrawn amounts, ticking fees before funding, agency fees, utilization fees, and letter of credit fees. Operationally, the key is understanding whether the fee belongs to all lenders, specific lenders, or only the agent. I would set up the fee schedule in LoanIQ, validate accrual frequency and basis, generate borrower invoices, collect cash, and distribute amounts according to the credit agreement. Question 9. If cash received from the borrower does not match the expected amount in LoanIQ, what would you do? This question evaluates your cash break investigation skills, escalation judgment, reconciliation discipline, and ability to protect client and lender relationships under time pressure. While answering, focus on comparing expected versus received amounts, checking value date, currency, interest, fees, withholding tax, bank charges, SSI, and timely escalation. I would first compare the cash received against the LoanIQ expected amount by component: principal, interest, fees, currency, and value date. Then I would check whether withholding tax, bank charges, FX, or a partial payment explains the difference. If the break remains unexplained, I would contact Treasury, the borrower, or internal client service. While escalating to the team lead, I would not distribute incorrect amounts to lenders until the variance is resolved or approved. Question 10. How do amendments and waivers affect syndicated loan operations? The interviewer wants to assess your ability to translate legal changes into operational updates, including pricing, maturity, covenants, commitments, fees, and lender consent thresholds. Make sure to cover reading amendment documents, identifying changed economic terms, consent tracking, effective dates, LoanIQ updates, fee processing, notices, and maker-checker review. Amendments and waivers can change the economics or administration of a loan, so operations must read them carefully. They may adjust pricing grids, extend maturity, increase commitments, waive covenant breaches, change lenders, or add fees. I would identify the effective date, required consents, and all affected facilities. Then I would update LoanIQ, process any amendment fees, issue notices, and ensure a second-level review confirms the system matches the executed document. Question 11. What controls are important when setting up or changing standard settlement instructions? This question evaluates your awareness of payment risk, fraud prevention, maker-checker controls, client authentication, and the consequences of incorrect wire instructions. In your answer, talk about independent verification, authorized signers, callback procedures, dual approval, static data controls, restricted access, audit trail, and prepayment validation. Settlement instructions are high-risk static data because an error can send funds to the wrong account. I would require authorized documentation, independent verification, callback where policy requires it, and dual approval before any SSI change becomes active. Access should be limited, and every change should leave an audit trail. Before large payments, I would revalidate the beneficiary, account, currency, and value date against approved records. Question 12. Explain pro rata sharing among lenders and why it matters in agency operations. The interviewer is testing your understanding of lender allocation logic, fairness across the syndicate, commitment percentages, payment distribution, and compliance with credit agreement terms. Be sure to mention lender commitment shares, proportional funding, proportional repayment, exceptions for defaulting lenders or specific fees, and reconciliation of lender positions after events. Pro rata sharing means lenders participate in fundings and receive repayments based on their share of the facility, unless the credit agreement provides an exception. If lender A has 20% of the commitments, it generally funds 20% of a draw and receives 20% of principal repayments. This matters because the agent must treat lenders consistently. In LoanIQ, I would verify lender shares before and after events to avoid misallocations. Question 13. How would you prioritize your work on a busy day with multiple rate sets, payments, and notices due? This question evaluates your time management, risk-based prioritization, deadline awareness, communication style, and ability to operate in a high-volume banking environment. While answering, focus on cutoff times, value date risk, borrower funding needs, payment deadlines, exception queues, team communication, escalation, and documenting completed control checks. I would prioritize by financial impact and deadline. Same-day fundings, borrower payments, and market cutoffs come first, because missed value dates create client impact. Next, I would handle rate sets, notices, and items with external dependencies. I would keep a tracker showing deal, event, cutoff, owner, and status. If capacity becomes tight, I would escalate early, not at the deadline, and make sure control checks are not skipped. Question 14. What should happen operationally if a borrower misses an interest payment or enters default? The interviewer wants to assess your understanding of default event handling, payment monitoring, escalation protocols, default interest, lender communication, and operational sensitivity. Make sure to cover payment confirmation, grace periods, credit agreement terms, notifying relationship or credit teams, default interest, lender notices, system status updates, and avoiding unauthorized action. If a borrower misses an interest payment, I would first confirm whether cash is truly missing or delayed due to value date, wire, or reconciliation issues. Then I would review the credit agreement for grace periods and default interest provisions. I would escalate to credit, legal, and the agency manager before taking action. Operationally, I may need to update LoanIQ, issue notices, track default interest, and ensure lenders receive accurate information. Question 15. What makes syndicated loan operations at large agent banks like Wells Fargo, Barclays, or Citi challenging? This question evaluates whether you understand the scale, control environment, client expectations, regulatory scrutiny, and cross-functional coordination required at major agency banks. In your answer, talk about high transaction volume, complex facilities, global currencies, strict cutoffs, LoanIQ controls, lender communication, documentation accuracy, audit readiness, and operational resilience. The challenge is scale combined with precision. Large agent banks handle complex multi-lender, multi-currency facilities with tight deadlines and high client visibility. A small setup or allocation error can affect borrowers, lenders, accruals, and regulatory reporting. Success requires strong LoanIQ discipline, clear communication, careful document interpretation, and timely escalation. I would focus on accuracy, audit trail, and understanding the economics behind each transaction, not just processing tasks mechanically. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.